All right, I'm back with blockchain tech and finance. If you're on the YouTube side, please do subscribe, turn on the bell notifications. We're gonna read through cool stuff for the day going on. Check the monitor levels. I can hear it all working just fine and dandy. Check my vocals levels. If you're on the chats, go ahead and throw your chats in there. What you think is important to be covered here in the news. If monitor levels are working great, cool. And I'll throw it up on the screen here on the chat overlay. You can throw it up there. It'll be featured here. So again, this is blockchain tech and finance, live every day, weekday at best. And if you're into NFT artwork, you can search KinsArt on OpenSea and Foundation for my NFT artworks. You can follow me on TikTok, KinToshi follow me on Instagram, KinToshi and follow me on Twitch, KinToshi for extra gaming content and social creation over there. Otherwise, let's go right on into the news for the day. So this is blockchain tech and finance, the place where we don't read the news while we're reading the news because people don't want to hear the news. Let's go. So Vitalik reveals a new phase in the Ethereum roadmap, the Scourge. So we're going to start with some blockchain news. Then we're going to go on to some NFT news, some metaverse news, blockchain news, cryptocurrency news, NFT news, metaverse news, tech news, and finance news, and global piece of news before we close out the stream here. All right, this is from writer Braden Lindria for Cointelegraph. It's a new phase in Ethereum's roadmap, the Scourge. The remaining milestones of the Ethereum roadmap consist of this. The Surge, the Scourge, and the Verge, the Purge, and the Splurge. Ethereum co-founder Vitalik Buterin has added a new stage into the Ethereum technical roadmap, one that aims to improve censorship resistance and decentralization of the Ethereum network. The Ethereum network's new plans were revealed by Buterin on November 5th. Twitter post, which produced the Scourge, and a now expanded 6-part technical roadmap. Following Ethereum's shift to proof-of-stake network on September 15th, Ethereum has been in the second stage, the Surge, with the goal of getting to 100,000 transactions per second through rollups. The updated technical roadmap now inserts the Scourge as the new third stage, which will be followed by the previously known stages, the Verge, the Purge, and the Splurge. So right here is their tweet right there. According to the Ethereum roadmap, the goal of the Scourge is to ensure reliable and credibly neutral transactions inclusion and to avoid centralization and other protocol risks from MEV. The Ethereum co-founders call for a more credible neutral consensus layer comes as miners have been known to exploit transactions on the Ethereum network to their favor. Buterin has previously described a credibly neutral mechanism as one which does not discriminate for or against any specific people. Miner extractable value (MEV) occurs when a miner front runs other participants in the network by deciding which transactions are to be placed in a block and in what order. This allows miners to duplicate all winning deals from the mempool and execute their transactions ahead of arbitrage seekers or anyone attempting to make profit. As a result, Ethereum has become associated with a higher degree of centralization and censorship following the merge. Following the network's transition to proof of stake, the percentage of blocks compliant with the U.S. Office of Foreign Assets Control (OFAC) reached 73% on November 3rd, a figure many consider to be far too high. Ethereum bull and founder on the Daily Gwei, Anthony Sassano, previously said in a Twitter post on October 15th that censorship resistance is more important than scaling at the current moment. Ethereum protocol upgrades in order of importance over the next 6 to 12 months: beacon chain withdrawals, PBS/CR lists, / related censorship resistant upgrades, proto dank sharing EIP 4844. In just my humble opinion, censorship resistance is more important than scaling right now. So that's one person's take on this and the tech aspects of Ethereum's blockchain. While the full details of the Scourge have not been disclosed, the Ethereum co-founder recently proposed a partial block auction solution where a block builder is only offered the right to decide some of the contents of the block. On other proposals to combat censorship at the consensus layer have been put forward, such as Ethereum research and development company Flashbot's single unifying auctions for value expression (SUAV) solution. UAVE solution. Buterin also confirmed an update to the Verge, which will now invoke the integration of succinct, non-interactive argument of knowledge (SNARK) technology onto Ethereum. Nice. Okay, checking my monitor just real quick. The addition of snarks will add much needed privacy. So ZK snarks and ZK rollups are basically a protocol that's used heavily in Monero, a privacy coin for traceless transactions. So they're going to put the addition of snarks, for privacy preserving features, as the Ethereum network while still allowing for anonymous transactions to be traceable. Buterin also noted that a more explicit role for quantum proofness would be implemented at various stages of the Ethereum roadmap as a necessary component of the endgame protocol. So definitely there's going to be a lot rolling out and a lot of upgrades to Ethereum. So Vitalik reveals a new phase in the Ethereum roadmap, the Scourge. Let's keep going. Our next piece of blockchain news. What is human-powered blockchain? So I found this Cointelegraph from writer Sasha. Cointelegraph. What is humanoid? Humanoid is the first human-powered crypto biometric network where one human equals one node equals one vote. Humanode is a new decentralized crypto biometric network that integrates pioneering cryptography with private biometrics and blockchain technology. The project aims to create a strong and sustainable decentralized system that is grounded on the existence of unique human beings. The Humanode project was conceived by the co-founders of Paradigm Research Institute in 2017. They were one of the many who were optimistic about the Web3 potential, but at the same time were stumped by the fact that mining cartels and validator oligopolies seem to dominate the crypto market. By using human biometrics as the stake, the founder of Humanode saw the possibility of creating a truly decentralized network of equals. Humanode enables a range of new cases while solving problems with existing ones, while Humanode enabling the pseudonymous biometric DIDs tied to various online services. Many spheres stand to benefit from, such as insurance, financial services that involve credit score trading, marketplaces, yield farming, and many others, including airdrops, healthcare, metaverse authentication, and non-fungible token NFT ownership. So what problems does Humanode solve? Humanode brings decentralization, civil resistance, and innovative governance models to the blockchain industry using biometric technology. In its very foundations, the Humanode project aims to bring accessibility, inclusivity, and innovation in the tech and crypto spaces and economies as a whole. The project is an alternative to the majority of blockchain networks that are based on consensus algorithms such as proof of work (POW), proof of stake (POS) that currently dominate the field. It is known that proof of work and proof of stake are decentralized technologically, but not power-wise, granting voting rights and rewards in proportion to users' economic investments in an activity or resource, stake or computational power, leading to capital-based oligopolies and mining pools. In contrast, POW and POS, Humanode utilizes facial recognition biometrics with the combination of proof of uniqueness and proof of existence, efficient tools capable of creating a decentralized protocol to counter malicious attacks on online platforms. The most spread attacks on peer-to-peer networks are Sybil attacks, with the utilization of multiple fake virtual identities, or in the case of cryptocurrencies, nodes. The Humanode system is designed to check and ensure that every person in the network is unique and has singular identity. Human nodes are created through crypto biometric authentication, which is a combination of cryptographically secure matching and liveness detection mechanisms verifying the uniqueness and existence of real human beings. Decentralized equality and civil resistance to the system. Human node design guarantees every individual the same amount of voting power and rewards, creating a democratic and fair peer-to-peer structure. So how does it work? Humanode is a project that gracefully combines different technological stacks, including blockchain and biometrics. It encompasses a bunch of layers, such as blockchain layer represented by a substrate module, a biometric authorization module based on cryptographically secure and neural networks for the private classification of three-dimensional 3D templates of users' faces, a private liveness detection mechanism for identifying real human beings, a Vortex decentralized autonomous organization DAO, and a monetary algorithm named FATH, where monetary supply reacts to real value growth in a mission if proportional. So in the detail, they have this Humanode tech stack, the FATH monetary algorithm and rebalancing system, the EVM, so Ethereum virtual machine compatible smart contract layer, the biometric search and matching, the substrate framework, consensus agnostic protocol. They got the decentralized audible liveness detection, so basically face recognition, and the Vortex DAO, which is basically the participants network in the voting structure of it. A decentralized autonomous organization. So the substrate framework, Humanode is a layer 1 blockchain whose architecture lies at the substrate open source framework that allows the quick development of highly customized blockchains. Substrate and brainchild of the Parity team provide interoperability with the Polkadot and Kusama ecosystems, as well as the environment for creation and deployment of general purpose or specialized blockchain networks with remarkably varied parameters and sound capabilities. Being a substrate-based chain, Humanode benefits from it and from the high throughput and scalability inherent to the Polkadot ecosystem. So Polkadot also has, I think, a cryptocurrency attached to it, its own cryptocurrency to its consensus. One of the interesting features of Humanoid is consensus agnosticism, which is the ability to change the network's consensus mechanism if the Humanoid DAO approves it. It derives from the necessity of constant research on the most suitable consensus for a leaderless system with equal validation power of nodes. Different consensus mechanisms have numerous pros and cons which constantly change. Swappable consensus mechanisms allow the system to evolve and to not be limited by a single unchangeable framework. EVM, a compatible smart contract layer. On top of that, Humanode is Ethereum compatible. Due to an Ethereum virtual machine EVM palette, Humanode can use existing Ethereum development tools and take advantage of smart contracts development supported by several popular languages including Solidity and WebAssembly. On the other hand, Humanode can provide private biometric processing and Sybil resistance to numerous Ethereum-based decentralized applications, including dApps, including decentralized finance, DeFi, and play-to-earn GameFi projects, NFT solutions, DAOs, metaverses, and others. So they have private biometric search and matching. As for Humanode's biometric stack, it seems that the privacy and security of biometric data has been among the most critical aspects of the project. Yeah, I would agree the same. Due to the private classification of images of users' faces, the system guarantees the image's privacy, performing all operations without the user's biometrics data having to leave the device. The only device needed to pass biometric authentication is a smartphone with a camera. Once users scan their faces, they become human nodes. The whole process is private and secure. All the human node system cares about is if the user is a unique human being, if they are registered, and if they are still alive. Decentralized liveness detection, a technique that ensures the biometric sample is submitted from a real live person, a substantial security feature that mitigates the vulnerability of biometric systems to spoofing attacks, is called liveness detection. Biometric liveness refers to the use of computer vision technology to detect the actual presence of a living user rather than a representation such as a photograph or a mask, video or screen, a fake silicon fingerprint, or other spoof artifacts. Biometrics accuracy grew tremendously in the last decade. Currently, the possibility of a match between two different people is 1 to 125 million, and the possibility of spoofing an identity without a real human in front of the camera is 1 to 80,000, and these numbers are constantly improving. For its first time, the version of the crypto biometric identification solution would utilize secure enclaves. For some portions of the process, Humanode integrates face biometrics and liveness detection. Humanode's first testnet was launched in January 2021, and the official testnet 1 with liveness detection and an updated technical stack was launched in September 2021. Since then, there have been additional testnets deployed, with more than 10,000 people becoming human nodes. In the Vortex DAO, there are 3 types of nodes on the humanoid ecosystem. First, human nodes who have passed biometric authentication received a fraction of the network transaction fees. Then there are delegators nodes that opt to delegate their voting power, and so-called governors. Governors are nodes that participate in the human nodes governance and must meet certain government governing requirements. Each of these node types forms an important part of Humanode's governance DAO named Vortex. Unlike other projects which allow nodes to accumulate voting power based on how much capital they have to delegate, the Humanode platform ensures that all nodes are equal in terms of validation and voting power, bringing true equality between peers in a decentralized environment. They have a fast monetary algorithm and rebalancing system. I'm going to kind of skip through here moving forward a bit to keep this stream rolling. Humanode implements the FATH hypothesis at the basis of the circulation of HMND Humanode token. HMND FATH is a monetary algorithm with a proportional distribution of issued tokens. It is an alternative to modern fiat credit cycle financial networks and capital-based public blockchains. What is crypto biometrics and how does it work? Crypto biometrics is a mix of innovative technology, advanced technologies including blockchain encryption, cybersecurity, zero knowledge proofs, biometrics, and liveness detection. For registered Humanode users, once they log in after biometric identity verification, the 1 to N search and matching operation happens in encrypted space. And because it's ZK based, so basically ZK snarks, and, right? Looks like ZK rollup. Based, the only piece of information that is searched for and is given out is whether the user is registered. Is that what that means? ZK based? Seems like it. Yeah, ZK proofs right here. All right. So they got the humanoid features. It provides biometric symbol of resistance with ensured decentralized biometric identification based on liveness detection. The network is owned and operated by real, unique humans. So they have key features: privacy preserving, cost-based fees, accessibility, quality, ease of integration, biometric symbol resistance, self-sovereignty, pseudonymity, usability, and availability. I'm going to close this out. The future of blockchain and biometrics merge. The merge of blockchain and biometrics has cognate potential. A new emerging ecosystem based on here is here to improve human life. As such, biometric-based blockchain projects formalize a new framework for the prosperous and regenerative world, each in its own unique way. Some of them specialize in identity verification for blockchain services. Some of them provide solutions for metaverse authentication, and some are interested in improving things like universal basic income (UBI). Be that as it may, they accelerate a possible new human future where an inevitable uniqueness and equality are the main powers. So that's right here with what is humanoid power? What is what is human powered blockchain? So that's very interesting to me. I'm going to research that more, most definitely. Let's keep going. That was a bit of a longer article there. From Cointelegraph, writer William Suberg. Bitcoin will quickly vanish when CBDCs launch, says Arthur Hayes. Looking to buy BTC to avoid the CBDC horror story. The best time was yesterday, the former BitMEX CEO said. In his latest blog post titled Pure Evil, Arthur Hayes, ex-CEO of crypto derivatives platform BitMEX, argued that banks may limit the impact of the CBDC horror story. Bitcoiners and banks stand against CBDC dystopia. CBDCs are currently in various stages of development worldwide. Fans of financial sovereignty naturally fear and even despise them, as they imply total government control over everyone's money and purchasing power. A full frontal assault on our ability to have sovereignty over honest transactions between ourselves, said Hayes. Among opponents of CBDCs are not only Bitcoiners, however, sharing the cause will likely be the commercial banks they have sought to oust from power with BTC. I believe the apathy of the majority will allow governments to easily take away our physical cash and replace it with CBDCs, ushering a utopia of dystopia of financial surveillance, the blog post explained. But we have an unlikely ally that I believe will impede the government's ability to implement the most effective CBDC architecture for controlling the generative populace, and that ally is domestic commercial banks. In implementing a CBDC, a government could either make the central bank the only node in the digital network, or use commercial banks as nodes in a less radical overhaul of the financial system. These systems Hayes calls the direct model, and wholesale model, respectively. Given that every country that has at least reached the choosing of a CBDC model stage has opted for the wholesale model, it's clear that no central bank wants to bankrupt their domestic commercial banks, he reasoned. There's some schematics here: direct CBDC, hybrid CBDC, and intermediated CBDC. You can research on the article links I have in the recap videos on the YouTube side. As such, to placate banks to a certain extent, but still achieve benefits such as eradicating governments may ultimately be kept in check by the kind of entities known for limiting crypto exchange transactions and banning holders' accounts. For politicians who care more for power than benefits, this is their chance to completely destroy the influence of too big to fail banks, and yet they seem to remain politically unable to do so, Hayes added. So capital controls are coming. The topic of CBDCs received extensive attention even beyond the crypto industry, as they represent a major shift in both money and politics. In an interview with Cointelegraph last week, Richard Warner, development economist and professor at the Montfort University, described them as a declaration of war. In other words, the bank regulator is suddenly saying we're going to compete against the banks now because the banks have no chance. You can't compete against the regulator, he said. Hayes, meanwhile, flagged Bitcoin as a safe haven, still available for those already opposed to any form of zero cash economy, but not for long. Buying BTC will become increasingly difficult or perhaps outright impossible once CBDCs are implemented. This window won't last forever. Capital controls are coming, and when all money is digital and certain transactions are not allowed, the ability to purchase Bitcoin will quickly vanish, he warned, adding, if any of this doom porn resonates with you and you don't own at least a very small percentage of liquid net worth in Bitcoin, the best day to have bought Bitcoin was yesterday. So buying Bitcoin will quickly vanish when CBDCs launch, so says Arthur Hayes. Going to the next article here. It's from CNBC. In bankrupt Lebanon, locals mine Bitcoin and buy groceries with Tether as $1 is now worth 15 cents. Once known for its stable an investment-friendly banking system, Lebanon has plunged into chaos as hyperinflation grips the country and banks force huge haircuts on dollar withdrawals. The key points here. Further, this is also from Mackenzie Zagalos, writer for CNBC. To make ends meet in a financial system that no longer makes sense, some Lebanese are mining Bitcoin or storing wealth using the cryptocurrency. The dollar-pegged stablecoin Tether, which users trade for cash, is also popular. When Giorgio Abu Gabriel first heard about Bitcoin in 2016, it sounded like a scam. But by 2019, as Lebanon plunged into a financial crisis following decades of expensive wars and bad spending decisions, a decentralized and borderless digital currency operating outside the reach of bankers and politicians sounded a lot like salvation. Gabriel was an architect living in his hometown of Beit Mari, a village 11 miles due east of Beirut. He had lost his job and needed to figure out another way to quickly get a hold of cash. In spring of 2020, Gabriel says the banks were closed and locals were barred from withdrawing money from their accounts. Receiving cash via international wire transfer wasn't a great option either, since these services would take US dollars from the sender and give Lebanese pounds to the recipient at a much lower rate than the market value, according to the 27-year-old. I would lose around half of the value, explained Gabriel of the experience. That's why I was looking at Bitcoin. It was a good way to get money from abroad. Gabriel discovered a subreddit dedicated to connecting freelancers to employers willing to pay in Bitcoin. The architect's first job was to film a short commercial for a company that sold tires. Gabriel was paid $5 in Bitcoin. Despite the tiny amount, he was hooked. Today, half of Gabriel's income is from freelance work, 90% of which is paid in Bitcoin. The other half comes from US dollar-denominated salary paid by his new architecture firm, beyond which a convenient way to earn a living. Bitcoin has also become his bank. When I get paid from my architecture job, I withdraw all my money, continued Gabriel. He then uses that cash to buy small amounts of Bitcoin every Saturday. The rest he keeps as spending money for daily needs and home renovations. So he isn't alone in seeking alternative ways to earn, save, and spend money. In Lebanon, a country whose banking system is fundamentally broken after decades of mismanagement, the local currency has lost more than 95% of its value since August 2019. The minimum wage has effectively plummeted from $450 to $17 a month. Pensions are virtually worthless. Lebanon's triple-digit inflation rate has expected to be a second only to Sudan this year, and bank account balances are just numbers on paper. Not everyone believes that the banks are bankrupt, but the reality is that they are, said Ray Hindi, CEO of Zurich-based management firm dedicated to digital assets. The situation hasn't really changed since 2019. Banks limited withdrawals, and those deposits became IOUs, and you could have taken out your money with 15% haircut and then 35%. And today we're at 85%, continued Hindi, who was born and raised in Lebanon before leaving at the age of 19. Still, people look at their bank statement and believe they're going to be made whole at some point. I want to get to the point of, this is like going on and on and on and on and on. Let's talk about the Bitcoin mining. That's what I'm here. Like, this is way, this is ridiculousness. It is a lot. Read this at your own due diligence. Research this, but it's just like, there's so many points here. I mean, let's just talk about basically, we're just going to say they're mining Bitcoin because their banks have locked them out of withdrawing their money, or they can withdraw their money from their bank accounts, which they own all their money, they're getting penalized up to like 85%. So basically, yeah, this is a long article. I'm going to have this in the recap, but we're not going to read this. We don't have time to read this. We got to keep going here. But this is basically saying Bitcoin as a bank. The key points here. Yeah, they're mining in their own cryptocurrency. This is crazy. I've never seen such a long article from CNBC like this. So Bitcoin offers a system that is uncorruptible, a system that's basically permissionless and censorship resistant. He said no one can really devalue Bitcoin due to its monetary policy, which is 21 million Bitcoin. Ultimately, money is a human belief system. For some in Lebanon, it has been a lifeline. For others, a passing fad. Al Chama hasn't turned crypto, and he stands by the decision even after spending time reporting on the ground at Abu Daher's crypto mines. If you look at what Bitcoin and Ethereum are worth today, I mean, it's worth a fraction of what it was a year ago. So I'm kind of glad I didn't get into it, says Al Chama. Warren Buffett is basically saying that it doesn't have an intrinsic value, and just passing it on to the next person and helping make a profit off that doesn't make any sense. So I'm a bit skeptical, said. But in other regards, on transactional basis, again, people who are mining Bitcoin here are taking their Bitcoin and they're living off of it, whereas other things like $1 in Lebanese dollar is now worth 15 cents, whereas the Bitcoin is stable and worth more, and they're mining it and we're using that to live off of. That's part of the structure of Bitcoin's network. Is validating and producing the network has a reward, and that reward is allowing people to live in certain areas where their own economy and their own monetary fiat currency is you can't live off of it anymore. I survive. OpenSea breaks silence on NFT royalties, but creators don't like what they hear. This is from Crypt. Creators around sound the alarm after the marketplace revealed its plans, which include blacklisting rivals and potentially optional royalties. This word, I mean, royalties are already optional. Maybe optional for the user who is buying the NFT. This is from writer Andrew Hayward for Decrypt. OpenSea shared its plans regarding NFT creator royalties amid a growing trend of rival marketplaces not honoring them. Notable creators suggest that OpenSea's messaging is unclear and potentially misleading, and that part of its plan is anti-competitive. As many NFT platforms shifted away from honoring creator-set royalties in recent weeks, top marketplace OpenSea had remained silent on the subject, apparently weighing its options. On Saturday night, the $13.3 billion startup finally showed its hand, but OpenSea's newly expressed strategy isn't sitting well with many prominent Web3 creators. On a Twitter thread, OpenSea shared what it called a thoughtful, principled approach to NFT royalties, including the rollout of a system that would let creators of new projects blacklist certain marketplaces that do not require traders to pay royalties. That system takes effect on November 8th. OpenSea said that it will consider what to do about existing NFT projects, and that it will garner additional community feedback ahead of self-imposed December 8th deadline. I mean, myself, I'm core to OpenSea basically. Just albeit, I'm open to have explored Magic Eden, and I'm very bullish on Blur, but Blur Marketplace. But otherwise, yeah, core to OpenSea, and always have been for basically since the start, for many years. Over about going on 7 years or something. Yeah, so it will garner additional community feedback ahead of a self-imposed December 8th deadline. After that date, the marketplace will make a decision, which would ultimately include making royalty fee payments optional for traders, as some other marketplaces have done. And they're gonna have to do that to keep up, right? In transparency, the consideration set for what happens after December 8th is wide open, with options ranging from continuing to enforce off-chain fees for some subsets of collections, to allowing optional creator fees, to collaborating on other on-chain enforcement options for creators, and the marketplace tweeted. In a company blog post, OpenSea co-founder CEO Devin Finzer detailed the firm's history of honoring NFT royalties, typically at 5% to 8% fee set by the creator, which is paid by the seller on any secondary market sale. These royalty expectations are not fully enforceable on-chain. However, the largest marketplaces, including OpenSea, have typically honored them. Unless the smart contract behind the collection has rolled up the royalties based in the contract, so it's impossible to get around it. When you're buying the NFT, it's rolled up in the transaction. We'll see more about that. In recent months, many upstart and rival marketplaces have attempted to claw away market share by offering zero royalty trading or making them optional. Nearly the entire Solana NFT market now operates with those models after Magic Eden made royalties optional for traders, and Ethereum platforms like X2Y2, LooksRare, and Blur have followed suit. When creator royalties fees aren't required, many traders opt not to pay them. Data from X2Y2 in late December, shared by pseudonymous proof director of research Punk 9059, showed that just 18% of traders bothered to pay any royalty amount. Free riding is too easy, they said. Finzer attempted to take a firm stance on this post, writing in partially bold text, "It's clear that many creators want the ability to enforce fees on chain, and fundamentally, we believe that the choice should be theirs to make. It shouldn't be a decision made for them by marketplaces." However, OpenSea's overall message isn't resonating as clearly as the single comment, with many NFT creators sounding an alarm on social media over what they believe are misleading comments or unclear intentions over the marketplace's true path forward. Blacklisting rivals. OpenSea's new enforcement system provides code for Ethereum NFT creators to insert into their newly launched NFT smart contracts, which points to a blacklist that blocks those NFTs from being traded at any listed zero royalties are royalties optional marketplaces. Smart contracts contain the code that powers the NFT projects and autonomous decentralized apps, or dApps. It's a similar approach to that recently taken by famed generative artist Tyler Hobbs for his new QQL project. Hobbs and collaborator Dandelion West implemented a similar blacklist that bars the NFTs from being traded on platforms that don't respect creator royalties. X2Y2 in particular complained about being blacklisted, suggesting that it compromised NFTs owners' rights. Fellow creators widely supported Hobbs and Wist on their project-centric blacklist, but in OpenSea's case, the blacklist is a who's who of direct competitors: X2Y2, LooksRare, Blur, and SudoSwap. The firm's guidance for creators to block those marketplaces looks anti-competitive to some NFT traders and creators who have sounded off on Twitter. But again, I mean, if you're going to launch your collection through OpenSea and their new features, that's just an option, it seems like. OpenSea is losing to put that code into the contract. And if you don't want that, you don't want that there. You don't have to have it there. OpenSea is losing market share to other marketplaces that are, let's see, that's not really so much important. It's really actually not, they are, but not to the tune, like, because the other marketplaces are so low in liquid movement of NFTs anyways. It's really nice. OpenSea is still the biggest, I'll tell you, I'll put it that way. Angarad Hari Thomas, director of product of Proof, tweeted that the move may only further centralize market power and dominance for the platform. OpenSea royalties are completely off-chain, she wrote. They're actually saying, if you block our zero royalty competitors in your contract, we'll turn on royalties for you in our centralized system. I mean, yeah, there's that, I guess. Whatever. The bigger question, arguably, is what's OpenSea's plan? What OpenSea's plans mean for creators of existing NFT projects? The firm said that it could make royalties optional for traders, but it may also enforce them for some subset of collections or utilize their potential enforcement methods ahead. Creators may need to change their projects and deploy new contracts to utilize such methods. No. Nope. It's all unclear for now, and Finzer's affirmation toward honoring royalties isn't much assurance for some creators and traders. After all, top Solana marketplace Magic Eden backed royalties and said it will continue to honor them, and then flip-flop only days later as rivals chewed away at its market share. Some have alleged similar smoke and mirrors tactics from OpenSea. In my opinion, OpenSea announcement is a clever reframing of taking existing collections to zero royalties, wrote Betty, the pseudonymous co-creator of NFT project Deadfellas. This will disproportionately fuck over emerging artists and marginalized creators who will need to turn to VC funding. Statistically, over 95% of VC funding goes to men. She remained unconvinced after speaking with OpenSea executives today. It feels like there is no plan and no clear answers were given in regards of existing collections and artist royalties. She tweeted, communication has been misleading and facts are not there. Artist Ryan, thank you, X Wilson, suggested that the announcement was another slap in the face from, this is getting a little too negative to me. I mean, you're just like bashing OpenSea to the ground. Like, give them a chance. So, sheesh. I'm going to try and jump around a little bit. In setting a deadline that's at least 1 month out, OpenSea is taking a more deliberate and public approach towards deciding royalties than many other of its competitors. Although Rarible has already taken a stand on royalties, still some artists are skeptical of OpenSea's aims, and they are trying to rally people in the NFT space to help get the message across. Philosophically, abandoning creator royalties throws the entire mission of Web3/NFTs off. Bobby Hundreds tweeted, "Until now, the primary thesis of this remarkable technology has been ensuring that artists get paid for their work. Therefore, it is now on you, the collectors and creators and the critics, to be heard and decide what happens." He added, "As the biggest mainstream NFT marketplace, if OpenSea subtracts creator royalties, will significantly impact the entire ecosystem." So I like this closing statement, and that's true. Us, the creators, collectors, and critics. OpenSea's hearing us out, and they're going to make a decision here on by December 8th deadline. Okay, I'll leave it at that. Let's keep going here, because this is going to connect over into what I'm about to read here, and it's a more positive light. This is also from Cointelegraph, from writer Steve Katz. The OpenSea launches on-chain tool to enforce NFT royalties. The royalty enforcement tool only applies to new NFT collections at this stage, with the decision to be made on existing collections at later date. Non-fungible to NFT marketplace OpenSea appear to have taken a position in NFT royalties debate, launching a new on-chain tool helping creators enforce royalties. The NFT marketplace, which according to CoinGecko commands 66% of the market share in NFT marketplaces that have so about 70% of this market share has been relatively silent in the issue of royalties and enforcement, while others in the space have been implementing their own strategies over the past few months. On November 6th blog post, OpenSea CEO Devin Finzer noted that in marketplaces where fees are optional, they've watched the voluntary creator fee payments rate dwindle to less than 20%, while in other marketplaces, creator fees are simply not paid at all. There's a lot of discussion over the past few months about business models for NFT creators and whether creator fees royalties are viable. Given our role in the ecosystem, we want to take a thoughtful, principled approach to this and lead with solutions. Finzer described the tool as a simple code snippet which allows creators to enforce royalties on new and future NFT collection smart contracts and existing upgradable smart contracts. The code will also restrict NFT sales to only marketplaces that enforce creator fees. It's clear that many creators want the ability to enforce fees on chain, and fundamentally, we believe that the choice should be theirs to make. It shouldn't be a decision made by them for marketplaces, Finzer said. Finzer also said OpenSea will enforce royalties for new collections using an on-chain enforcement tool, but won't do so for new collections that don't opt in. So this is basically just an extension here of the tool, basically. I don't fundamentally agree with the removal of royalties, though I do appreciate the execution. There has been give and take with these things, recognizing you are making an unavoidable change that harms your audience, but also simultaneously presenting a solution. Other users had questions they felt were unanswered, not answered. Betty, the pseudonymous one for creators of the Deadfellas NFT collection, told their 89,000 followers, "It feels like there is no plan and no clear answer to be given in regards to existing collections and artist royalties." Again, it's going to be answered. Just going to get some time. Although later node, I look forward to reading more concrete communication from them soon in regards to proposed strategies. Yeah, okay, good. After speaking with OpenSea, it feels like they're, yeah, okay, I'm not going to say that again. So that's that there. I just wanted to put that connective piece in there, that they have an on-chain tool. This is the part that is going to be from the past connective article about their on-chain tool, a code snippet that's going to go into contracts or upgradable contracts to allow for these protocols to further take place here. All right. Continue on into some NFT news here. Wuhan emits NFTs from metaverse plan amid regulatory uncertainty in China. This is from Prashant Jha, writer for Cointelegraph. Chinese government has shown a keen interest in developing a metaverse economy, but its stance on NFTs hasn't been very clear. The Chinese city of Wuhan had reportedly shelved its aspiration non-fungible token NFT plans amid growing regulatory uncertainty around the cryptocurrency and Web3 technologies in the country. Wuhan first announced its plans to support metaverse and NFTs in the aftermath of the coronavirus breakout as a measure to boost its economy ruined by the pandemic. The city was the epicenter of the COVID-19 breakout, so they had an industrial plan for the city's metaverse economy developed. Development included a line about NFTs. However, that part has now been omitted from the latest version, according to the report by South China Morning Post. The report noted that the revised version still encourages businesses to focus on decentralized tech and Web3, but makes no mention of NFTs. Under the newly revised plan, Wuhan aims, because they're going to use the word digital collectibles instead, probably. Under the newly revised plan, Wuhan aims to foster more than 200 metaverse companies and build at least 2 metaverse industrial estates by 2025. Looking at the revised version of the draft, the Chinese government seems to do away with anything that involves the exchange of tokens and digital properties or digital properties. The stance has been clear over the years as the government development plans have included metaverse-related technologies. For example, several Chinese cities, including the capital of city of Beijing and Shanghai, have announced metaverse innovation plans, but any private business or tech giants involved with NFTs have faced government hostility. At the start of the year, China was aiming to separate NFTs from cryptocurrencies in a bid to help nascent industry growth, despite a blanket ban on the latter. This resulted in a peak interest among Chinese communities as NFT marketplace OpenSea was flooded with listings from Shanghai during COVID lockdowns. However, with the rise of popularity, the number of fraudulent activities rose as well, leading to several government warnings to investigators against NFT trade. China was very clear with the stance on crypto use in the country and eventually imposed a blanket ban in 2021 after several years of numerous restrictions. However, the government's stance on emerging Web3 technologies, especially those that involve the exchange of tokens of digital collectibles or NFTs, seems far from clear at the moment. Wuhan omits NFTs from the metaverse plan amid regulatory uncertainty in China. Let's keep going. All right, this is from Braden Lindria, writer for Cointelegraph. Meta reportedly plans large-scale layoffs, but what of its metaverse division? At the end of September, Meta had more than 87,000 employees, a large portion of which they said to work in the Reality Labs division. Social media and tech giant Meta is reportedly gearing up for large-scale layoffs this week amid rising costs and recent collapse of the share price. According to the Wall Street Journal WSJ report on November 6, citing people familiar with the matter, the planned layoffs could impact thousands of employees in a broad range of divisions across Meta's 87,000-strong workforce. It is not currently understood whether the firm's Reality Labs division, which registered a $3.7 billion loss in the first quarter, could see staff cuts. Last week, Meta CEO Mark Zuckerberg said that the company would be focusing on its investment on a small number of high-priority growth areas, including its artificial intelligence, AI discovery engine, and its advertisement and business messaging platforms, in addition to the metaverse stating. So that means some teams will grow meaningfully, but most other teams will stay flat or shrink over the next year. In aggregate, we expect to end 2023 as either roughly the same size or even a slightly smaller organization than we are today. During the earnings call, the billionaire entrepreneur appeared to double down on the firm's investment in these areas, saying that he believes they're on the right track with these investments and should keep investing heavily in these areas. The report comes only a week after Meta reported its third quarter earnings, which missed revenue expectations and saw a rise in its operating costs. Its stock price also took a battering, with shares in Meta currently priced at $90.79, down 7.56% over the last 5 days and 73% down year on year, according to Yahoo Finance. The company appears to be actively hiring into its metaverse division regardless, and with its list of job openings revealing 38 of its 413 listings are related to augmented reality and virtual reality. Cointelegraph has reached out to Meta for clarification on whether there would be any changes to its metaverse division, but did not receive an immediate response. And I'm almost like personally like within myself, like maybe scoop up some Facebook stock again, or sorry, now Meta stock, for back when I had the Facebook stock. That's just my own thought for myself. Yahoo Finance article. It's an economic quandary and the Fed sees only one way out. So we're going to shift over to some finance news. This is from writer Sam Rowe, contributor to Yahoo Finance. It's an economic quandary and the Fed sees only one way out. Stocks fell last week with S&P 500 declining by 3.3%. The index is now up 5.4% from its October 12th closing of a low of $3,577.03. Yeah. right? Yeah, the S&P 500 stock, and down 21.3% from its January 3rd closing high of 4796.56. The market moves came amid confirmation that the labor market remains very tight and a reiteration from the Federal Reserve that it has ways to go before the central bank could declare victory in its fight with inflation. All of last week's developments are related to a pretty complex way. Are related in a pretty complex way, but it all ultimately boils down to one thing. Oh man, my mouth is getting so dry from reading two news articles, news sessions here. Wait, this isn't news. What are we talking about? This is just reading stuff. We are taking forceful steps to moderate demand so that it comes into better alignment with supply. Fed Chair Jerome Powell said on Wednesday. You might hear like my children or something like playing or I don't know, throwing toys at each other. Who knows? Sorry, ahead of time. Yes, broad measures of economic growth are cooling, and expectations for corporate earnings growth have been deteriorating. But these trends belie what continues to be a very strong underlying demand. Economic activity would be hotter and corporate sales would be more robust if businesses had more workers on staff to address all of the demand. So this corroborated by the fact that there were a whopping 10.7 billion job openings as of September, or nearly 2 job openings per unemployed person. Various business surveys confirm that this scramble to hire amid a tight labor market. Overall, 61% hiring reported hiring or trying to hire in October, down 3 points from September. 55%, 90% of those hiring are trying to hire. Of owners reported few or no qualified applications for the position they were trying to fill, down 2 points. 30% of owners reported few qualified applications from their open positions, up 3 points, and 25% reported none, down 5 points from September, 48-year record high. It's from the National Federation of Independent Business. There are still challenges in hiring qualified workers. Institute for Supply Management Services (PMI) stated overall labor market conditions remain tight. Though half of districts noted some easing of hiring and/or retention difficulties, competition for workers has led to some labor poaching or by competitors or competing industries able to offer higher pay. From Goldman Sachs, analysts of Q3 earnings calls, most firms continue to hire in order to satisfy strong levels of customer demand. Unfortunately, while these labor job openings represent a massive tailwind for the economy, they also explained why we continue to have higher inflation. That's because employers have to raise wages aggressively to recruit and retain workers, which forces them to raise prices on what they're selling to offset higher costs. At the same time, higher wages and continued job growth puts more money into the pockets and more and more consumers, further fueling demand amid tight supply. All this is reflected by a metric called the Index of Aggregate Weekly Payrolls, the product of jobs, wages, and worker hours worked. Think of it as a total nominal spending capacity of the workforce according to the Bureau of Labor Statistics, BLS. This metric increased by 0.2% month over month in October to a record high of 176.7, reflecting an 8% jump from a year ago. Before the pandemic, the annual growth rate was trending at around 5%. In the Fed's eyes, raising wages and job growth, which continue to fuel demand, are all bad news in the context of inflation, and so it continues to tighten monetary policy aggressively, even if it means economic pain. The broader picture of an overheated labor market where demand substantially exceeds supply. Powell said, "We keep looking for signs that sort of the beginning of gradual softening is happening, and maybe that's there, but it's not obvious to me because wages aren't coming down." In the effort to bring down inflation you can't bring wages up and like bring them back down. Hey employee, I brought your wages up, but hey employee, I got to cut your wages now, and then your employees leave, and you don't want that because they go over to the next job that's still offering competitive wages. So this is a mess. In its efforts to bring down inflation by slowing the economy, all the Fed can do really is intervene in the financial markets by tightening financial conditions, and tighter financial conditions manifest in the forms of rising interest rates, a stronger dollar, and falling stock valuations. As long as we get data that signals inflationary pressures, like Tuesday's report showing job openings have increased, the Fed will continue to act in ways that are unfriendly to the financial markets and the economy. So So there might be a way out of this. Fed-sponsored demand destruction may not be the only way out of the inflation problem. The solution could certainly come from the supply side, such as a lot of job openings getting filled, enabling companies to produce more goods and services, or food and energy pressures ease amid de-escalation in Ukraine. But there's actually a ton of evidence to suggest supply chains have already improved significantly, and there's also evidence companies could be reining in prices, as reflected by the fact that corporate profit margins remain near record highs. Then why are prices coming down faster? Paul Donovan, chief economist of UBS Wealth Management, wrote about this in an opt for the Financial Times on Wednesday. Emphasis added, companies have passed higher costs onto its customers, but they have also taken advantage of circumstances to expand profit margins. The broadening of inflation beyond commodity prices is more profit margin expansion than wage cost pressure. How is this happening? Two forces have combined. Despite negative real wages, consumers have carried on consuming. Strong post-pandemic household balance sheets have allowed lower savings and increased borrowing to offset the sorry state of real wages. The resulting resilience in demand has given companies the confidence to raise prices faster than costs. In other words, companies aren't cutting prices because consumers have the financial capacity to pay up. This is unfortunate. This is the unfortunate downside of all this hiring, and it's why all the excess savings consumers have accumulated is actually an economic curse. Donovan also argued that the power of storytelling has conditioned consumers to accept price rises. Indeed, the Fed and others have been very vocal about how inflation is tied to wage growth, and consumers seem to be buying stories that seem to justify price increases, but which really serve as cover for profit margin expansion, Donovan said. Perhaps another way out of the inflation problem is to shift the narrative consumers are hearing, which would put corporations under more pressure to cut prices. From Donovan, higher unemployment and lower wages are not the only possible cure for it. Policy has more routes to lower inflation if the cause is about profits. Of course, higher unemployment and lower wages could weaken demand and squeeze profit margins, but any softening in demand, for instance, through slowing the leverage of household balance sheets, would also affect pricing power. I'm going to really kind of start to jump around here because we want to get through. Yeah, this article is going on and on and on. Here we got some wage growth. Changing jobs can get you a bigger raise. Job openings rise. Man, there's some really long articles going on today about these marketplace sentiments across the board. Layoff activity remains low in BLS data. Unemployment claims remain low in BLS data. What's that BLS data? Yeah. Employers are getting more out of their workers. Labor productivity is up from the BLS. Non-farm business sector labor productivity increased 0.3% in the third quarter of 2022 as output increased 2.8% and hours worked increased 2.4%. Maybe people are just kind of like, what am I going to do? I'm going to go home and watch a show or something and sit down and fall asleep. Or I might work an extra couple hours. What's it to me? Work the extra couple hours, make this extra money or something in this type of marketplace because of inflation, because of buying milk and eggs and stuff like that. Manufacturing cools. The ISM's manufacturing PMI fell to 50.2 in October from 50.9 in September. A reading above 50 signals expansion, which suggests manufacturing activity continues to expand, but at a decelerating rate. The manufactured goods supply chain is improving. Manufactured good prices fall. Let's see, but services prices are up. Auto sales are picking up. Credit card interest rates are going up. So the average variable credit rates is now 18.77%, the highest since February of 1993, according to Ted Rossman, senior industry analyst at Bankrate. It will soon blow past the all-time high record of 19% set in July 1991. He said at the start of the year, the average credit card charge is 16.3%. So putting it all together, the economy is slowing. The good news is that there's enough underlying demand that it's supporting the labor market. The bad news is that job growth and rising wages are helping keep inflation high. As such, the Fed continues to tighten monetary policy, which means the market beatings will continue and the risks and the risk the economy sinks into recession will intensify, right? Because inflation is high, spending is low. Recession occurs because ultimately no one's spending on the things, the goods that are being produced from the people who are being paid more to produce them. And if they aren't being paid more, they're leaving your job over into another competitive job, and then the unemployment rates are wildly volatile. Unemployment to employment rates are just wildly volatile, going all over the charts. There's ink from people bouncing around. There's a strong case to be made that any downturn won't turn into economic calamity, given that the financial health of consumers. There's a strong case to be made that any downturn won't turn into economic calamity, given that the financial health of consumers and business remains very strong, and long-term investors should remember that recession and bear markets are just part of the deal when you enter the stock market with the aim of generating long-term returns. While markets have had a terrible year so far, the long-run outlook for stocks remains positive. Yeah, so that's that for there. It's a long one. Definitely. Could have watched the video maybe. Seems like they rolled it up in 1 minute. It's an economic quandary and the Fed sees only one way out. Article. Let's go on here. I have a few more article pieces to keep going through here. The old UK growth model is dead. What long-term weak pound means for Britain. This is from Jenny Reed. The key points here is I'm going to start skipping around a little further. You can read these articles in full in the recap videos on the YouTube side. I have all these articles in the description. The recent highs and lows have all played out within a range that sterling has not traded at against the greenback since 1984. In mid-2007, at the precipice of the financial crisis, it was possible to get $2 for a pound. In April 2015, it was still worth $1.5. At the start of 2022, $1.3. This historically weaker pound on a medium to long-term basis has a variety of impacts on the UK. More broadly, economists told CNBC. And so in London, the British pound exchange rate against the US dollar has been a roller coaster ride in recent months. After the year of steady decline, it plunged to an all-time low beneath $1.10 after the UK government's infamous mini budget in late September. It then recovered to 1.16 after the country swapped its finance and prime ministers in late October and sank to 1.11 after the Bank of England downplayed rate hike expectations and warned the UK had already begun its longest ever recession on November 3rd. The recent highs and lows have all played out within the range that the sterling has not traded at against the greenback since 1984. In mid-2007, at the precipice of the financial crisis, it was possible to get $2 for a pound. In April 2015, it was still worth 1.5, and at the start of 2022, 1.3. Almost all currencies have declined against the dollar this year, and sterling's depreciation against the euro has not been as severe given the European Union's own challenges with economic slowing and energy supply. But the euro is still much stronger than it was against the pound in the 1990s and for most of the 2000s. And the pound's global importance has evaporated since the days when it was the world's reserve currency in the early 20th century. Let's see. Historically weaker pound on a medium to long basis has a variety of impacts in the UK. More broadly, economists told CNBC the problem that the UK is very import dependent. Almost 2/3 of food is imported. All right, the economy is a low wage economy that will hurt in the long run situation. Richard Ports, professor of economics at the London Business School, also noted that the UK's reliance on foreign trade, which means a significant impact on prices from a weaker currency, though he said there is not yet evidence of a significant effect on UK demand for foreign goods, but nor was there on exports, which theoretically become more competitive. He also noted currency depreciation had a level effect on prices rather than being inflationary. It's a one-side effect. It's not necessarily giving us inflation in terms of continuous rise in the level, he said. All right, sterling's depreciation is a long-term trend since it was allowed to float freely in 1971, he said, telling CNBC. I think it's reasonable to expect that to continue. That's particularly because productivity and therefore competitiveness has not been very good relative to our trading partners. So that's the long run situation. The UK's current account deficit, which is where a country is importing more goods and services than it's exporting, and stands at 32.5 billion for Britain. In finance, by capital terms, he noted former Bank of England Governor Mark Carney has said the UK is dependent on the kindness of strangers, but Port said it's not their kindness, it's them wanting to invest because they find their projections as possible yields. Investors find UK assets sufficiently attractive to bring in capital. If they find it less attractive, UK assets would fall in value to induce people to invest more, so the exchange rate will fall further. That depends on confidence in the British economy, fiscal policy, and all those things. Let's see. The growth model is dead, according to Blythe. Beyond the pain suffered by households, the higher prices caused by a weaker currency will have deeper and longer-lasting effects. The UK is heavily consumption-based economy, and such a shift is equivalent to a tax consumption. That means that less fuel in the economic engine. The UK already had a low growth and even lower productivity growth. The potential upside to exports was negotiated by Brexit, he said, pointing out that the UK economy had declined from 90% to 70% of the size of Germany's since the 2016 vote. So what does this mean long term? It means the old UK growth model is dead, Blythe continued. Financing your consumption from other people's savings, capital imports, and swapping overpriced houses had a shelf life. It passed. The combination of a structural fall in the exchange rate plus positive inflation ends. The appeal for cheap British assets only held if they are going to be revalued, he said, and the GBP is not the USD, period. Adjusting to this, the great British pound. Adjusting to this new reality will be painful but necessary for the long term, Blythe believes. The UK is not independent upon Greater London generating 34% of GDP, with the North and West living off transfers. Is a better UK. It will just take time, reimagination, and investment to get there. So that's this article. The old UK growth model is dead. What a long-term weak pound means for Britain. Let's keep going here. We're going to shift over to the tech sector. From the BBC News, Twitter users jump to Mastodon, but what is it? This from writer Zoe Kleinman. In the wake of Elon Musk's takeover on Twitter, some users have been seeking alternative platforms. One of the biggest beneficiaries has been Mastodon. But what is it? The social networking says it now has over 655,000 users, with 230,000 having joined last week. On the surface, Mastodon looks like Twitter. Accounts users write posts called toots, which can be replied to, liked, and posted, and can follow each other. Under the bonnet, though, it works in a different way. That's one of the reasons it's attracting fresh users, but it has caused some confusion to new people signing up. What are all these servers? The first thing you have to do when you sign up for it is choose a server. There are loads of them. They are themed, country by country, city by city or interest, like the UK, social, technology, gaming, and so on. It doesn't get huge. It doesn't hugely matter on what one you're on, because you will be able to follow users on all the others anyway, but it does give you a starting community who are more likely to post things you are interested in as well. Some of the popular ones, such as social in UK, are currently running very slowly because of demand. Ryan Wild, who is running the Mastodon app UK server via his firm, Superior Network, said he has over 6,000 new joiners in 24 hours and had to pause registration. I wanted to see what the hype was about, he said. I stood the server up at 10 p.m. Friday night, and I woke up the next morning to 1,000 people I didn't know would rock up. How do you find people? The server you choose to become a part of your username. For example, I use my current Twitter handle ZSK and chose UK server, making my username ZSK, whatever, at the Mastodon thing, and that's my address there. They could look me up at. Our name on the server, you can search just using the person's name, but if they are on a different server, you will need their full address. Unlike Twitter, Mastodon won't suggest followers you may be interested in. You can also search hashtags. Why are the servers there? Okay, this is complicated, but I'm going to try and get a little simple. Mastodon is not one platform. It's not one thing, and it's not owned by one person or firm. All these different servers link together and form a collective network, but they are owned by different people and organizations. Let's skip all this stuff. Was called decentralized and fans of decentralized platforms like them for exactly this reason. They can't be run at the whim of a single entity, bought or sold. However, the downside of this is that you are instead at the whim of a person or organization running your server. If they decide to abandon it, you lose your account. Mastodon is asking server owners to give their users 3 months notice if they decide to close it. The original founder of Twitter, Jack Dorsey, is working on a new network called Blue Sky. By the way, he has said that he wants to be decentralized too. Is Mastodon moderated? This is a real hot potato at the moment. All the servers have their own moderation rules, and some have none. Some servers are choosing not to link to others that are full of bots or seem to have high quantity of hateful content. This means they will not be able to be visible to those on servers where they are blocked. Posts can be also reported to the server owners. If it's hate speech or illegal content, then those owners can delete it, but that does not necessarily delete it from everywhere. Are there any ads? No, there are no ads, though. Although there's also nothing to stop you from writing a post promoting your company's product. Mastodon also doesn't offer a curated experience like Twitter does in terms of how you view posts. You generally see what your followers are saying as they say it. Is it free to use? It depends on which server you're on. Some are asking for donations as they don't get paid, but it is largely free. That's something here. Twitter users jumping to Mastodon, but what is it? Let's keep going here. I have a few articles before we close out the stream for the day. Keep moving this along. Experts discuss the future of technology in cities in STS panel. A group of former mayors and professors discussed the future of cities at a panel hosted by Harvard Kennedy School's Program on Science, Technology, and Society in afternoon. I'm going to skip through this, just kind of get the main key points here. All right. Panel focused on this concept of a city that uses technology to city issues and improve communication between city leaders and their constituents, and the implications of regarding integrating new technologies into city planning. The innovative ride-sharing and transportation startups like Uber fill a gap in the market. Davis said they come at the cost of neglecting high-need areas and populations from socioeconomic groups. Found that the planning and implementation process that can make possible the adoption of sought-after smart mobility policies may also inadvertently worsen mobility and accessibility gaps. Former New York City Mayor Bill de Blasio said he observed the unintended consequences of using smart technology during his time in office. According to Blasio, New York City partnered with the private firms Intersection and ZenFi networks to turn payphones to kiosks through Link NYC, which would offer local information and free Wi-Fi, but the kiosks have not been used as planned. It turned out that a lot of individuals who did not have something better were using the kiosk to get service, to watch pornographic movies. De Blasio said attendee Dennis F. Kunchoff, who works at the Francois Javier Bagnaud Center for Health and Human Rights, pushed back against de Blasio for framing his story about the Wi-Fi kiosk as a technology failure instead of a failure on the city's part to deal with the homelessness crisis. In response, de Blasio said these technologies are often hard to implement in a way that immediately makes progress on a multi-generational project. The kind of religious, what the world? Religious, I'm going to skip that word. I don't even know what that is. Man, if I can't talk today, I don't know what. Panelist Raphael, basically it's like saying smart cities and innovation for innovation's sake is often met on the ground with entirely different realities. Knowledge-based economy requiring really good cooperation between businesses and academia and open international society. What this panelist noticed his city uses. During a panel discussion, Jason B. Jackson, an assistant professor of political economy at MIT, urged academics not to lose sight of the past when considering the future of cities. As we think about the kind of possibilities for new urban technologies, it's useful for us to think back on the past as well as to see what we can learn from earlier experiences with create novel new types of cities, Jackson said in an interview with the Crimson after the event. Martin A. Hager, a professor of urban futures at Utrecht University in Netherlands, talked about the role urban planning experts can play in making cities more sustainable and less reliant on fossil fuels. Academics must stop only analyzing the past, but also start to provide these alternative futures, these aspirational futures that show how that the post-fossil city is worth living, Hajar said. That's from the Harvard Crimson here. A little brief. It wasn't the most strongest article, but okay. I was trying to look for something about technology and smart city growth. Maybe I was concerned about what types of further technologies other than a kiosk booth that people weren't even using other than to watch porn in. So it wasn't the strongest article, but still had some debate in it that was noteworthy, right? Within itself, its own right. Now, this is in the tech sector. Web inventor Tim Berners-Lee wants us to ignore Web3. Web3 is not the web at all. This is from Ryan Brown, writer for CNBC. Key points here is Tim Berners-Lee, the computer scientist credited with inventing the World Wide Web, said he doesn't view blockchain as a viable solution for building the next iteration of the internet. In fact, Web3 is not the web at all, he told an audience at a Web Summit Tech Conference in Lisbon. Berners-Lee said people too often conflate Web3 with Web 3.0. His own proposal for reshaping the internet. I kind of agree with the term Web3 applying to blockchain technology because blockchain technology is still dependent on the internet. And blockchain is an attachment that works within UX, UIs, and domains that are Web 2 based, right? So, Web 3.0. He's saying is not what is like Web 3 is like. To me, it's like blockchain technology can create its own ecosystem, but it's still rolled up into the whole web structure altogether, whether it's Web 2 or Web 3. Let's just call it the web. 2.0 or 3.0 or 4.0, blah, blah, blah. It's just the web, and new innovations are going into the web. So web now integrates blockchain technology into its utility. Does that make it 3.0? Who cares? Some people do. Apparently they want to decipher some word on something, a label. The creator of the web isn't sold on crypto visionaries' plan for its future. It says we should ignore it. Tim Berners-Lee, the British computer scientist credited with inventing the World Wide Web in 1989, said Friday that he doesn't view blockchain as a viable solution for building the next iteration of the internet. He said he has his own web decentralization project called Solid. It's important to clarify in order to discuss the impacts of new technology, said Berners-Lee, speaking on stage at the Web Summit event in Lisbon. You have to understand what the terms mean that we're discussing actually mean beyond buzzwords. It's a real shame, in fact, that the actual Web3 name was taken by Ethereum folks for the stuff that they're doing with blockchain. In fact, Web3 is not the web at all. Web3 is a nebulous term in the tech world used to describe a hypothetical future vision of the internet that is more decentralized than it is today and not dominated by a handful of powerful players such as Amazon, Microsoft, and Google. It involves a few technologies, including blockchain, cryptocurrencies, and non-fungible tokens. Yeah, and I kind of make this strong debate too. Is just the use of blockchain, cryptocurrency, non-fungible tokens strong enough to really say it's a Web3 experience? I'm kind of like, not so much. It's still like Web 2, but just you're utilizing a web blockchain technologies in your Web 2 experience, basically. While breaking out our, currently, that's the stance in my mind, right? While breaking our personal data out of big tech's clutches is an ambition shared by Berners-Lee. He is not convinced blockchain and distributed ledger technology that underpins cryptocurrencies like Bitcoin will be the solution. Blockchain protocols may be good for some things, but they're not good for Solid, a web decentralization project led by Berners-Lee. He said they're too slow, too expensive, and too public. Personal data stores have to be fast, private, and cheap. Cheap and private. Ignore the Web3 stuff, random Web3 that was built on the blockchain. He added that we're not using that for Solid. Berners-Lee said people too often conflate Web3 with Web 3.0. His own proposal for reshaping the internet, his new startup, Inrupt, aims to give users control of their own data, including how it's accessed and stored. The company raised $30 million in funding round in December, TechCrunch reported. Berners-Lee say that our personal data is siloed by a handful of big tech platforms like Google, Facebook, and that uses it to lock us into their platforms. The result was a big data race where the winner was the one corporation that controlled the most data, and the losers were everybody else, he said. His new startup aims to address this through 3 ways: a global sign-on feature that lets anyone log in from anywhere, login IDs that allow users to share their data with others, a common universal API or application programming interface that lets apps pull data from any source. Berners-Lee's not the only notable tech figure with doubts about Web3. The movement has been a punching bag for some leaders in Silicon Valley, like Twitter founder Jack Dorsey and Tesla CEO Elon Musk. Critics have say it's prone to the same issues that come with cryptocurrencies, like fraud and security flaws. So yeah, web inventor Tim Berners-Lee wants us to ignore Web3. Web3 is not the web at all. Web3 is blockchain technology. It's Web 3.0 is still being built upon, I guess, in some right. I don't know. I don't really know what to think at the time of it. We're working with what we're working with. That's what it is. And the future will show the latter outcome will show the true valuation of what's being used and what the stance is, consensus. So this is the last piece of article I'm going to read from today. Brace for mass attacks on power grids, Zelensky says. Kyiv's residents told to prepare to evacuate. This one from writer Holly Elliott for CNBC. So I went into some blockchain news, crypto news, NFT news, metaverse news, tech news, and finance news and tech news. Now we're into a piece of general global news. Ukraine's President Volodymyr Zelensky warned Sunday night that Iranian drones, which Ukraine says Russia is using to attack its cities and energy networks, could be used to launch another barrage of attacks on its energy infrastructure. In his nightly address, Zelensky said Ukraine understands that Russia is concentrating forces and means for a possible repetition of mass attacks on our infrastructure. First of all, energy in particular. For this, Russia needs Iranian missiles. He said Ukraine is preparing to respond. Vitaly Klitschko, I'm not sure, the mayor of Ukraine's capital, Kyiv, said Sunday that residents have to be prepared for an eventuality, including evacuating the city, as Russia continues to target energy infrastructures. Attacks that have left the capital without any power or water recently. Lastly, defense experts have warned that are warning that Ukraine is at risk of running out of air defense weapons and needs the West's urgent help to defend against a tide of cheap Iranian supplied drones targeting its infrastructure of its energy. Russia issues rare denial of pointless losses by Marines. It's basically like that. It's going on to different articles now. It's going to continue to grow. Let's see. Yeah, Zelensky warns more attacks on infrastructure could take place. Ukraine's President Volodymyr warned Sunday night that Iranian drones, which Ukraine says Russia is using to attack its cities and energy networks, could be used to launch another barrage of attacks. Okay, we read that. So basically, in closure, Russian forces have repeatedly targeted Ukraine's energy infrastructure in recent weeks, with Kyiv accusing Moscow of aiming to deprive citizens of heat, power, and water. As winter approaches, Moscow denies using Iranian drones to target Ukraine or targeting civilian infrastructure. Eastern Ukraine continues to be epicenter of hostilities this week, with Zelensky singling out the region, saying very fierce Russian attacks in the Donetsk region continue. The enemy suffers serious losses there, but despite any losses, he continues to drive his mobilized soldiers and mercenaries to their deaths, he said. This is from quote Holly Elliott for CNBC. All right, that's all I have for the day here on the news. If you're on the YouTube side, again, please do subscribe, turn on the bell notification here to blockchain tech and finance. I have this at best every day. So smash the subscribe button. If you're on the YouTube, if you are on OpenSea and you want to search NFT art, you can search my KINSAMURAI on OpenSea Foundation. Follow me on TikTok, KinToshi Follow me on Instagram, KinToshi and follow me on Twitch, KinToshi for extra gaming and social content creation over there. All right, that's all I have for the day today. Also, throw your chats in here, and I'll stream and feature them up here and there. What news do you find is important? What NFTs, cryptocurrency things you find interesting? If I'm missing something here, let me know. And also, all of these articles, again, are on the recap videos on the YouTube side in the description box. So also have a great and safe day wherever in the world you are. I pray it is awesome, cool, safe, and succeeding. I will see you back tomorrow. Subscribe, turn on bell notifications. Peace, ciao. Peace be with you. Take care.